welcome back to JPX Energy Market Weekly Updates. We're only 3 trading weeks into 2022. The oil market is faced with yet another supply disruption. Last week, oil flow along the Kirkuk-Ceyhan pipeline was cut after an explosion on January the 18th at a portion of the pipeline near Turkey's southeastern city. As you can see from this figure, crude oil from the Iraq northern region sent by this pipeline to Turkey were ships from the port of Ceyhan. By the way, the Federal Iraq is defined as the central government of Iraq and Baghdad, and the KRG, the official ruling body of the semi-autonomous region in northern Iraq that is predominantly Kurdish. Approximately 88% of Federal Iraq seaborne export were shipped from the southern terminals in the Persian Gulf, and the mainstream comes from the southern oil field. The KRG exported the vast majority of its approximately 450,000 barrels per day of crude production via this pipeline to Ceyhan. Iraq federal government also ships about 90,000 barrels per day of crude from its Kirkuk fields to Ceyhan in this pipeline. Turkey state pipeline operator completed repairs on the damaged pipeline the other day, and oil flows had already restarted. And freezing weather conditions are expected to hit Texas these days, posing a further threat to oil supply recently. Last year, power failure and wellhead froze hit oil and gas production, as well as refinery operation in the state. However, maybe the industry is better prepared for repeating the same conditions this year. And what's more, tensions between Russia and Ukraine remain high. Russia's Euro crude has gained about $1 per barrel against Brent from early to mid-January, reflecting the growing potential for a conflict between the two countries. About half of Russia's oil exports are sent to European countries where they account roughly a quarter of total oil imports. The growing list of supply disruptions that the market has witnessed, along with several key supply risks overshadowing the market, has ensured that recent sentiment remained bullish, so crude may see much volatility on the way down as it did on the way up. The first line and third line spread at JPX Dubai rose to a recent high of 1,370 yen per kiloliter, or $1.9 per barrel. That is $1.78 for Brent, both indicating a strengthening market. The spread of JPX Dubai and IC Brent remained range-bound last week and may get further support because this month could see a larger increase in Africa output, with recoveries in Ecuador, Libya, and high export from Nigeria on the way. The recent rise in oil prices is not entirely due to a supply disruption. It is also supported by recovery in demand and strong stock draws. In its monthly oil market report released last week, IEA raised its demand estimates by 200,000 barrels per day for both 2021 and 2022 to reflect clear signs that the impact on economic activity and oil demand from the Omicron variant remain relatively subdued. IEA's upward revisions to global oil demand estimates and a slightly lower outlook for world oil supply have tightened the balances outlook for 2022, although they still show surplus the whole year. The stock data shows the OECD crude and oil product stocks declined to 7-year lows in November, down 6.1 million barrels month-on-month, and a steep 354 million barrels year-on-year. Preliminary data for December shows the OECD stocks plunged by a further 45.2 million barrels. While December typically has the highest monthly stock draws, the latest decline was 35 more than normal. IEA's data also shows the group's production in December increased by 190,000 barrels per day, while the second sources in OPEC's report shows a similar case. Under the OPEC Plus deal, OPEC members could have increased output by around 240,000 barrels over the month. As a result, the gap between the group's output and its target widened to almost 800,000 barrels per day. This highlights well the concern that some OPEC members do not have the capacity to increase output further. The continuing erosion in Nigerian and Angolan capacity, along with other South-side Middle East, is likely to prevent OPEC Plus from fulfilling the agreed monthly 400,000 barrel per day increase for the 19 members subject to cuts. Besides, IEA now sees OPEC Plus spare capacity shrinking to 2.6 million barrels per day later this year from around 5 million barrels per day currently, if the producer group continues to unwind its supply cuts and Iran remain under sanctions. Shrinking spare capacity and low stock level will leave the oil market exposed to geopolitics and other supply risks, which means the oil market could be in for another volatile year in 2022. Okay, that's all for today. Welcome back next week.